Right now, a glaring analytical contradiction is tearing through the commodities market. By all traditional metrics, hard assets should be surging. We are in an economic environment defined by sticky inflation, aggressive deficit spending by the US government, and escalating geopolitical military conflicts. This chart shows the recent trajectory of gold prices. Despite those optimal bullish conditions, gold has plummeted roughly 18% since its peak in January. This creates what we can call the safe haven divergence, a direct clash between bearish charting data and bullish macro drivers. For institutional traders, this divergence indicates either a massive pricing error ready to be exploited or a structural shift in how capital evaluates risk. To understand the severity of this sell-off, we have to look at the technical reality of the active April gold futures contract. This chart shows the April gold futures, highlighting a distinct double top formation that occurred at the extreme $5,500 to $5,600 level. From that peak, the price action violently broke below the 50-day simple moving average. For market technicians, trading below this specific line signals a definitive shift away from positive market sentiment. Measuring the depth of this crash requires a short-term Fibonacci retracement dataset. The current sell-off has already blown past the 61% correction level. That brings the asset down to the critical 78% retracement level, which sits precisely at $4,568. If the price holds above that $4,568 line, this move qualifies as a steep correction. If it breaks below it, the probability of a structural bearish pivot comes into play. Right now, gold is hovering dangerously close to that 78% line in the sand. Technical analysis suggests a sell-off, but the underlying economic gravity continues to exert upward pressure on the asset. The macroeconomic data directly contradicts that technical breakdown. The current U.S. fiscal deficit exceeds $1 trillion annually. Every year, the government's spending outpaces its revenue by that specific magnitude. Historically, governments do not fix deficits of this scale by cutting spending. They print their way out of debt. That process devalues fiat currency and historically forces the price of hard assets higher. Compounding this is the Federal Reserve's dilemma regarding unchecked consumer prices. This graphic compares the Fed's strict 2% hardcore inflation target against the reality of sticky CPI, which is running at 3.4% or higher. To change that trajectory, a central bank typically raises rates to cool demand. But in their latest announcement, the Fed opted to simply maintain the current Fed funds rate. With over $1 trillion in annual deficit spending and central banks holding rates steady despite elevated inflation, gold's massive technical sell-off is mathematically inconsistent with the macro environment. To verify if this is an isolated glitch, we look at corroborating evidence across the broader precious metals market. Silver recently ran up to a high above $120 per troy ounce, before experiencing a dramatic collapse back down into the $70 to $80 range. This chart compares contract volume between the two metals. Silver experiences more violent volatility because it has far less liquidity, with significantly fewer active contracts than gold. Platinum and palladium have also suffered tremendous drawdowns alongside gold and silver. Because the entire safe haven metals complex is being liquidated simultaneously, the capital isn't simply disappearing, it is actively being rotated into a different asset class. This raises the central investigation: where are hedge funds and institutional traders parking this liquidated capital right now? The institutional capital rotation hypothesis provides a possible answer to the paradox. The specific asset absorbing this massive influx of liquidity is Brent Crude Oil. This chart tracks gold against Brent Crude. Notice the stark statistical divergence that began in late February. As gold sold off, crude oil spiked, moving in the opposite direction. The geopolitical catalyst driving this rotation is the escalation of military strikes involving the US, Israel, Iran, and multiple nations across the Middle East. The targeted shipping straits in that region are responsible for the transit of roughly 20% of total global oil production. Following the initial late February strikes, capital temporarily flocked to the US dollar index as a safe haven, adding downward pressure to gold. While the dollar remains a formidable safe haven, its recent percentage gains have been eclipsed by the vertical move in energy. Large-scale futures traders shifted positions accordingly, exiting gold and the dollar to capture the move in crude light. The current market math favors front-running a kinetic threat to the energy supply chain over holding a traditional inflation hedge. The focus now shifts from the past capital rotation to the future price target these institutions are hunting. This visualization maps the critical terminal threshold for the crude oil market, $120 per barrel. Even sustaining prices above the 100 mark creates immediate economic strain, but $120 per barrel serves as the mathematical breaking point for a petroleum-based global economy. At that level, a cascade effect hits corporations. They face severe margin compression as both raw production and transportation costs spike simultaneously. This translates directly into the destruction of consumer spending power at the retail fuel level, draining the income available for other goods and services. A sustained $120 barrel acts as a systemic contagion, choking the broader economy through every petroleum-dependent sector. This looming oil crisis connects directly back to the Federal Reserve's current monetary trap. The transmission mechanism is unavoidable. Astronomical transportation costs leak directly from headline inflation into the core prices of food and everyday goods. If that happens, it forces a monetary response. The Fed may have to abandon its holding pattern and aggressively hike interest rates to destroy demand. This chart brings us back to gold's current technical stance. The asset remains paralyzed in a neutral to bearish state, caught between moving back up through the 50-day moving average or breaking down entirely through that 78% floor at $4,568. Gold's immediate technical breakout or breakdown is no longer operating in a vacuum. It is heavily dependent on the geopolitical resolution of the crude oil supply chain. In a petroleum-based civilization, energy security dictates all capital flows, forcing even the oldest safe haven assets to bend to the price of a barrel.